economic news flow in the weeks leading up to and coming out of Christmas is going to be quiet, and the corporate news schedule looks pretty thin as well. So this seems a good time to sit back, think, and take stock. In our first Christmas video special, we took a look at the key trends which shaped financial markets in 2023. In this second one, we're going to try some soothsaying, without giving anything that could be misconstrued as advice, and have a stab at working out which trends might prove influential in 2024 and beyond, to help you as you do your own research and design your portfolios according to your own personal strategy, time horizon, target returns, and appetite for risk. Unfortunately, no investor or central banker or politician for that matter knows exactly what's coming next, and whether inflation, stagflation, or deflation will result from the combination of interest rate pauses, quantitative tightening, pay increases, rising debt, and elevated geopolitical tensions. Basing investment strategies on just one possible outcome or scenario could be risky, and portfolio construction may need to address a range of outcomes, especially as we have elections to be fought and electorates to be influenced on both sides of the Atlantic in the coming 12 months. Carefully following these 5 investment themes and how they develop may help you to fathom which way the wind is blowing, although if 2023 is any guide, this list is unlikely to prove exhaustive. So the first trend that may be worth following could be debt, which in many ways is probably the biggest issue of all. Debt to GDP is one barometer to watch, but according to the Bank of International Settlements, it should be studied in conjunction with the percentage of tax income that's used to meet interest costs by governments. When that latter figure got to around 20% in 2007 and was still rising, the financial markets buckled, the wheels fell off, and nearly took the global economy with them. China and France are the 2 countries in this invidious position now, but America's catching up fast as the Biden administration spends like fury on the CHIPS and Inflation Reduction Acts. America's latest annual fiscal deficit was $1.7 trillion in the year to September 2023, the 3rd worst number on record, and the annualized interest bill will hit $1 trillion, or 20% of tax receipts. America can't afford to keep interest rates where they are for so long, and there's the risk the Fed has to cut rates to keep the burden manageable, maybe take risks with inflation. This could in turn be why gold and Bitcoin, for that matter, are on a roll. Markets are pricing in 5 rate cuts from the Fed in 2024, but because inflation is cooling and growth benign, not because debt's a problem and interest costs are squeezing economic growth, so we may need to be careful what we wish. The second trend that may be worthy of attention is the one that's close to many people's hearts and pockets: wages. The 1970s inflationary outburst may have been prompted by loose monetary policy in the UK and loose fiscal policy in the US, followed by 1973's oil price shock. But a vicious circle of higher pay demands, higher wages, higher pay demands, higher prices, higher wages, higher prices, higher wage demands, and so on, developed and took hold. Financial markets may therefore cheer a modest increase in unemployment, and central bankers accept it, as higher joblessness could help to put a lid on wages and inflation, and thus provide scope for interest rate cuts, heartless as all of that sounds. Equally, a sharp rise in the jobless rate could signal economic trouble, or at least more than is currently factored in by consensus earnings forecasts, so policymakers and investors may have a tricky balancing act. The third trend that may be worthy of note is the performance of the so-called Magnificent Seven. The stock market's rally in 2023 and the return to favour of Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia and Tesla suggests equities are pricing in an economic soft landing and a return to the low growth, low inflation, low interest rate environment of the 2010s that did so much to help the performance of long duration assets like bonds and growth sectors in stocks such as technology. Now, markets could be right, but if they're wrong, and those 5 Fed cuts don't appear on schedule, or if they do appear for the wrong reason, then the Magnificent Seven's aggregate $11.8 trillion market cap could look a bit exposed for all of their dominant positions in their respective industries. Their share prices and profit wobbles of 2022 showed they're not entirely immune from the economic cycle, so an unexpected recession could be one challenge. Sustained inflation could be another if it keeps rates higher than expected and boosts nominal growth from downtrodden cyclicals and value stocks. Again, maybe only a perfect middle path will do. The fourth trend to watch is the yield curve and whether it steepens, flattens, or inverts even further. Bond yields are coming down, which means bond prices are going up, but the yield curve remains inverted, whereby 10-year yields on government bonds are lower than those on the 2-year in both the UK and the US. This is normally seen as a warning that recession is on the way, as it means bond markets are factoring in interest rate cuts. The 10-year would usually have to offer a higher yield to compensate holders for the extra risk for things to go wrong over the longer time span of the debt. This is not an infallible signal, and in fact it's been signalling recession for 18 months to no great effect, but examples of soft landings for the economy are hard to find, and stock markets are currently doing their best to ignore the bond market's quite different message. Finally, investors might like to keep an eye on oil and copper. If equities are pricing in a soft landing and fixed income markets a harder one, commodity traders are even more confused. We've already talked about gold. Now, oil's renewed weakness may speak of recession. Copper, a reliable indicator of global economic health due to its many uses, is doing nothing. Gold must be fretting about debt and stagflation even. The messages from stocks, bonds and raw materials are therefore contradictory. But such are the globe's debts that it seems likely central banks and politicians would rather play fast and loose and risk inflation or stagflation than recession and deflation. The experiences of 2007-9 and 2020-21 would suggest as much anywhere, because deflation would be a killer given all the debt that's sloshing around. I hope that was helpful and gives you some food for thought as you do your own research over the festive period if you ever get a chance. I hope that you and your family are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.